All right, let's talk about getting way more creative than just betting on whether the market's going to go up or down. We're about to open up a complete toolbox, really, filled with option strategies that let you build a trade for pretty much any view you can dream up.
Most people look at the market and they see a simple choice, right? Up or down. But what if you think the market's going absolutely nowhere? Or what if you expect a huge, explosive move, but you have no clue which way it's going to break? Just thinking in terms of up or down is kind of like being a carpenter who only owns a hammer. You're leaving a ton of great tools on the table.
Okay, so this is where the real magic of options comes in. See, they aren't just lottery tickets. Think of them more like financial Legos. They're building blocks. And with these blocks, you can build these really precise strategies that perfectly match your specific outlook, whether that's bullish, bearish, sideways, or just plain chaotic.
So, here's how we're going to organize our new toolbox today. We'll kick things off with some smarter directional bets using spreads. Then we'll get into the fun stuff, how to bet on volatility itself with straddles and strangles. After that, we'll look at a great strategy for investors called covered calls, show you how to add some protection with callers, and then we'll tie it all together at the end.
Okay, let's pull out our first set of tools. So imagine you have a strong feeling a stock is going to fall, but you're also, a little nervous about being wrong and getting wiped out. This is exactly what spreads are for. They let you act on your view while putting a hard, non-negotiable limit on your risk right from the get-go. Now, what's so powerful about this slide is the contrast. I mean, look at the left. Selling a naked call, if the market decides to just blast off to the moon, your losses are, and this is not an exaggeration, unlimited. That is terrifying. But the bear call spread on the right completely solves that problem. By just adding that second piece, buying a higher call, you create an absolute ceiling on your loss. It's basically like buying built-in insurance for your trade.
And you know what? Building one is surprisingly easy. Seriously. It's 2 simple steps. First, you sell the call that fits your bearish view, and that puts cash, the premium, right into your account. Then you just use a little bit of that cash to buy another call option that's further out. That second option is your safety net. It means you know your absolute maximum loss before you even place the trade.
All right, let's move to the next section of our toolbox. Now these tools, they're different. They don't really care which direction the market goes. No. These are for when your opinion is all about the size of the move you're expecting, whether that's a massive breakout or dead calm silence.
So think about this scenario. There's a huge event coming up, maybe a company's big earnings report or a pivotal election. You just feel it in your bones that the stock is about to make a massive move, but it could be straight up or straight down. How in the world do you trade that feeling?
Well, here's your answer. The long straddle. It's beautiful. You buy a call and you buy a put, both at the exact same price. This is a pure, undiluted bet on volatility. If the stock makes a huge move in either direction, one of your options is going to become incredibly profitable. So profitable, in fact, that it'll easily cover the cost of both. Your risk is capped at what you paid to get in, but your potential profit, it's unlimited. And this is just a brilliant analogy for the opposite strategy, the short straddle. In this case, you're selling both the call and the put. You're betting on stability. On boarding, really. As long as the market doesn't do much of anything, you just get to sit back and keep the premium you collected. The analogy is perfect. You make money as long as the horse, the market, stays right there on the saddle. Okay, let's shift gears a little bit. We've been talking about active trading, but what about strategies for long-term investors? Let's say you've got a portfolio of stocks you love, and you just want to make those assets work a little harder for you.
This brings us to the covered call, one of the most popular strategies out there for this exact reason. If you own at least 100 shares of a stock, you can sell a call option against those shares. You get paid a premium immediately. That's instant income. Now, there is a catch. There's always a trade-off, right? To get that income today, you have to be willing to cap your potential profit. You're agreeing to sell your shares if the price shoots past a certain level.
Okay, so what if you like that idea of getting income from a covered call, but you're still worried about protecting your stock from a big, nasty drop? Well, we can actually just add one more piece to the puzzle and create a protective collar around your investment. Let's just walk through how this thing gets built, step by step. You start with the covered call we just talked about, selling that call to bring in some cash. Then you simply take that cash you just made and use it to buy a put option. That put acts like an insurance policy. If your stock takes a nosedive, the put goes up in value, which helps offset your losses. You've essentially used the income from one option to pay for the insurance of another, creating this collar with very well-defined limited risk. So, we've just unpacked several really powerful tools from our new toolbox. Let's lay them all out on the workbench so you can see exactly which tool to grab for which job.
And here it is, your cheat sheet. It really is this simple. If you're feeling mildly bearish, your tool is the bear call spread. Expecting fireworks but don't care about the direction? You grab the long straddle. Think the market's just going to sit there and do nothing? The short straddle is your play. And for investors, you can generate income with a covered call or lock in your position and protect it with a caller. See? Every single view has a specific tool.
So here's the big takeaway. Options give you this incredible flexibility to build a strategy for any nuanced market view, far beyond just a simple bet on up or down. You've seen the blueprints for the tools now, so the only real question left is, what are you going to build with them?